So welcome to iAIM Investment Management Macroeconomic and Market Update. Today we're discussing our macro and asset classes outlook, performance so far this year, and the team's take for year end. My name is Royce Marcello and I'm Director, Client Portfolio Manager at iAIM. With me today for this conversation, Dominic Siciliano, who's the Senior Vice President, Head of Fixed Income. Dominic is the Head of the Fixed Income Strategy for both rates and corporate bonds. Thank you, Dominic.
Hey Rose, how are you?
Doing good. So we're discussing maybe the first topic of the day, index performance today, year to date, and in July, we've seen a big reversal. What's your take on this?
Yes, so we'll get a little bit maybe later on discussion on what rates have done to explain the move, but we've had quite a rally in the rate structure. The curve is still flat, but the general points in the 10-year point of the curve have rallied significantly, 60 or 70 basis points. So we went from total just the index, right? We outperformed the index as managers, but just the index itself went from maybe negative 12.25% year to date as of June 30th to negative 9% as of the latest data, if you want, in July. So we had about a 3%, 3.25% return just in 1 month on the rates rally. So it's a real good thing for those who listened to our last podcast and thought about maybe buying the dip. It was really proved beneficial. And I think that it won't take a lot of movement for us to get, if rates continue to go in that path, although they've retraced a little bit today. But if they continue to go along that path, some total return preference will come back. And if you compare that to, let's say, to a guaranteed rate structure where you probably earn 4% for the year or for 2 years, you made 3% return in a month just on the bond market. So there is a bit of a return there.
Yeah, and also underscores the importance of remaining invested. If you went cash, like late June, you missed that rally.
And you have access to your cash, Rose. That's another interesting thing, is because
Exactly.
at this
Daily
point
liquidity.
you've earned 1%, you've earned 3% return for the month, and now you can decide, hey, I want to sell it, I want to get back into equities, as opposed to being in a locked up structure where you don't have access to your money for a longer period of time.
Exactly. Good point. So we're going into Q4. What's your view on the path of rates? What's your view on the Fed? Are we close to a turnaround point?
So it's very interesting because we're in a technical recession, right? We've had two negative quarters in the U.S. of GDP growth, and which is, it's technical because employment is still strong. Although employment tends to be a very lagging indicator, you'll have a downturn in employment once the recession is really well started and entrenched, right? So I wouldn't look to employment as an indicator for continued confirmation of this recession. But the Fed has some really serious decisions to think about, and that's why the September 21 meeting becomes really, really important. If you look at the first slide on the rate path, which I showed you at the last time we discussed, you'll see the terminal rate was somewhere around 3.25, 3%. And now we're looking at rates going back down really aggressively in slide two, back to 2.5%. Doesn't mean it's going to necessarily happen, but it means that's what the market is pricing right here. So we've kind of had a shift in mentality because the rate hikes have a significant impact on the consumer, and it does has an impact on slowing down because people really feel it because of their consumption patterns, which are heavily based on credit.
Mhm. And in terms of the macro and geopolitical landscape, there's the new Inflation Reduction Act that was introduced, midterm elections coming. Do you see this having an impact at all on what the Fed could do or how rates could react?
It's going to have an impact if it has if it has a direct link to increasing or decreasing inflation. I think that focus by the Fed is really, really strong. And unfortunately, or fortunately, depending on how you want to look at it, these geopolitical events have had an impact on the inflation number. So when we talk about disruption, supply chain, so anything that's going to affect inflation will definitely have an impact on the Fed's decision or willingness to move rates. I felt that Powell at the last meeting was kind of telling investors September is important because we'll either have to really ratchet up, or maybe we'll start thinking about a pause. I still think that we're going to have some rate hikes, but the market is already pricing 3.25 on that aspect. And I think geopolitical risks going into the end of the year are going to be very important. One of the main reasons is because Russia has an ability to, let's say, control the supply of gas to Europe. So that will have some implications domestically, politically, and on the economy in Europe also. So we'll be watching those events.
You'll be watching those events. Well, great. That sums it up. Thank you so much, Dominic.
Thank you very much, Rose. Have a great day.
You too. Bye.